In the last slide, we saw what were the additions which were to be made to the profit as per profit and loss account. Now we will see what are the deductions which are to be made from the profit as per profit and loss account. This is just an exact opposite of the ones that we saw in the previous slide. So let us have a look at them. Expenses which are specifically allowed for income tax purpose but not debited to the profit and loss account. There are not many of them, but fact of the life is they are there. So let's say, for example, you are allowed 100% depreciation on a particular item. Okay? But you claimed only 30% because the accounting laws ask you to do 30%. Then this balance 70% is something which is allowed for income tax purposes, but you have not debited to the profit and loss account. Right? So expenses which are specifically allowed for income tax purposes but not debited to the profit and loss account. Second, expenses relating to the previous year but not debited to the profit and loss account. Right? So let's say, for example, last year you made a payment of 100 which was 50 for the last year and 50 for the current year. You booked this 50 but you did not book this 50 in the current year. So then this has to be reduced. Third, losses allowed but not debited to the profit and loss account. Okay, so if some stock is damaged, okay, damage of stock, that's a loss to the business. But if, let's say, for example, you haven't debited it to the profit and loss account, then while making your income tax deduction, you will reduce it. Incomes or receipts not taxable under this head but credited to the profit and loss account. Let's say, for suppose you have some interest on fixed deposit. Okay. Now interest on fixed deposit, as we know and as you will learn subsequently, is taxable under the head income from other sources. IFOS stand for income from other sources. If this interest is a part of profit and loss account, which is the starting point that you have taken here, then you need to reduce it because it is not taxable under PGBP. Okay, I've cleared it. Now move on to the fifth. Income or receipts taxable under other heads of income but credited to the profit and loss account. These two are more or less corollary, and the explanation for interest equally applies to this also. Other expenses not forming part of income but included in profit and loss account. Adjustment to stock figures. Okay, so if there are any adjustments which are to be done to the stock numbers, right, the one which I discussed earlier, which is not forming part of the P&L, then you reduce it. Okay, and income taxable under the other heads. I'm sorry, this is a repetition, so we can just ignore this. This is actually covered over here. Right? With that, we come to the end of the slides. Let's look at the next one.